Hi, so I just got off a conference call with Christian Nolting, who is the Chief Investment Officer of Deutsche Bank, and he was holding a conference call to discuss the current crisis that's going on. In fact, he's given it a name, the GHC, which I think is probably the name that's going to catch on. So we had the GFC, obviously, in 2008, which was the global financial crisis. This is the GHC, the global health crisis, and I think it's interesting that it's kind of put in those terms as well, because actually the global financial crisis, if you look at what happened to markets and the uncertainty that was going on in markets then, it was really resolved once everybody was satisfied that the central banks and the stakeholders that could do something about this had actually done something about it. And really the tone of the call was that the global health crisis is not going to be resolved until people feel that something can be done and that that they're on top of this, because obviously they've already taken all of the fiscal stimulus measures. In fact, there is now coordinated effort from all of the central banks with things to ease the economic impact of the event. But of course, this is a health crisis, so we need something to be resolved in terms of the health aspect. And they felt one of the key drivers for that could be, I guess the experiment is one way of putting it, which is the social distancing experiment that's being carried out in Italy. So obviously Italy was the first to have a complete lockdown. Spain has now followed, and they believe that this is a sort of 14 to 21 day experiment to see if the numbers of infected cases start to reduce. And if we do see that reduction at some point in the next week or two, then their belief is that you'll see a lot more of these social distancing measures executed in other countries all around the world, because it will be seen as a successful solution. And that might well be what the markets are looking for before the volatility kind of comes out of things and we get back to some kind of semblance of normality. And as I said in the earlier video, with all this fiscal stimulus piled in and what is effectively a short-term shock, there could well be quite a dramatic recovery to follow this particular one. And one of the things that they mentioned, which is of note, is that the DAX, which is the index of the top companies in the German Xetra exchange, the DAX is net asset value, so its book value is around 8,500, and I had a look just before this call and it was at 8,546. So it's trading at very, very close to book value. Now, interestingly, he said that's only happened at 3 occasions in history. One of them was the dot-com crash in 2001, 2002. The next time was the 2008-2009 the GFC, and then the time after that was the European debt crisis, which was around about 2011. Do you remember when they had to bail out Greece and all of that stuff? That's the only times that the DAX has touched its book value. And whenever it has done that, it has had a very strong recovery over the following 12 months. So it has kind of bounced back. And actually, if you look at the gap between dividends and bond yields, if you look at the dividend yield of the DAX versus the yield you get from European bonds, the gap is now up to 6%, which is a huge difference. Now, you could argue that these businesses are maybe going to have to look at cutting dividends in the short term, or that it may not actually achieve that 6%. But nonetheless, that is a very, very big gap to have between a normal index and the rate of borrowing in that country. So it was an interesting call. He obviously believes there will be a recession that comes off the back of the crisis, but that it will be the kind of short and deep recession, and that financial markets probably will be more focused on the resolution to the health problem rather than anything to do with the recession. He thinks that the recession is now more than priced in. They run lots of detailed calculations on fair value, and they believe that where we are now is oversold, but he would be reluctant to be long in any particular stock or index at the moment, that there could still be more volatility and more pain to come in the very short term. So from a strategic perspective, not to go long, but to look at other ways of positioning yourselves. If anyone's done the Harbour Club, or you're familiar with my stuff, we talk a lot about fixed coupon notes, which is a way of capturing value when there's market crashes, but earning a fantastic income while you're waiting. That strategy is doing fantastically at the moment. I priced some fixed coupon notes on Friday that give just incredible returns. Yeah, it's an interesting development. So I thought I would just share that with you, because not a lot of people get invited to these calls. It just tends to be high net worth individuals, private wealth clients, and those kind of people. So I thought I would share the kind of things that are being discussed on those calls. So yeah, the next big thing to watch, I think, really is the number of infected people starting to reduce, that turning point. And this social distancing experiment in Italy is probably the first one to watch. So yeah, probably another week or two of financial markets being extremely volatile, and then see where it starts to where it goes from there. But obviously at the other end, stay safe, and look after yourselves and your families. And if I come across any other interesting stuff, I will try and share it, because there is tons of really stupid fake news and crap that's swimming around out there, and I don't want to add to the already voluminous amounts of information that are being thrown everywhere. But I thought this might be quite useful, so I thought I would share with you all. Thank you very much.